talk to and to say, hey, what do you think about this? They can bounce these ideas off. They're going to feel much more comfortable doing that, and their stress levels are going to be way, way down.
Allow me to illustrate for a moment. Say we have a borrower moving into our area. He's being transferred with his employment, and he's only going to be in the area for 5 years. We may want to suggest a 5-year ARM at that point because his payments will be lower. Maybe some of the down payment requirements might be lower, but we only want to suggest a 5-year ARM for that program. However, if he tells us that, hey, this is my starter home, I'm going to be staying in the area, but I'm going to want to move out and move up. At that point, we'll say, well, buy the property, take a 30-year fixed for it, and use that investment property as a rental property. What you've done is you've got a primary residence rate, because we all know investment property rates are much higher than primary residences. So when you move into that property and you move out, as long as you're there for 1 year, that's the law, one year, when you move out, you have a beautiful rate on an investment property.
That's exactly right, and you bring up a real good point, that 1 year, because when they go to closing, they'll actually sign documents that say they will live in that property for 1 year. And this is one of the big areas that the FBI is starting to investigate.
Right.
Because in the past, people would say, oh yeah, I'm going to live in there, and my intent is to live in the property. And what would happen is 2 or 3 months afterwards, they would turn out and rent it. Well, that can cause you big problems these days. And that's one of the things you're bringing it back to your licensed mortgage loan originator is going to be able to point out to you that you really don't want to do this because you're putting yourself in big jeopardy.
They could call the whole note due.
Well, not only that, that's what they used to do. They used to slap your hand and say you got 30 or 60 days to pay that loan off. Now what they'll do is they'll go after you criminally. FBI now, for mortgage fraud, and this is one of their areas that they're focusing in on, up to 30 years in prison and $1 million fine.
That is
so they're not playing around with it. So when people come to us and say, would like to develop an investment portfolio or would like to get into more real estate properties, you got to be very careful how you structure that, because it's really not worth it to take that chance. You could end up in big, big trouble.
I've had associates come and knock on my door and say, hey, are you Mark Rigney Dealer here? So it does happen.
Absolutely. And it only used to be maybe 10% of the loans before the mortgage issues and meltdown that we've had.
Right.
Now, I would say in situations like that, it wouldn't surprise me if it's actually every loan. They're going to send mail correspondence. If it gets kicked back, that's a red flag. They're going to send spotters out to the house, knocking on doors, especially if there's something in the loan process that gives them a concern or an idea that something like that might be happening.
Yep, our industry is definitely under the microscope right now.
There's no question. It's under the microscope, and there's much more regulations and much more detail that's looked at than ever before.
Speaking of detail, what we need also is, once we find the product that fits the borrower's needs, is to make sure that they can afford it. And make sure, in addition to being able to afford it, that they're not going to be cash poor after they go to closing. An underwriter wants to see that you're going to have about 3 payments in the bank, so that after you go to closing, if you fall upon hard times, you miss a month's worth of work, you can make a payment till you get back on your feet or something.
Yeah, and depending on the loan program, some loan programs will go down to a month's reserves. And sometimes you've got really good credit scores, it can be a little bit less than a month. But the more reserves you have, and that means the more money you have after closing that you're not using for that transaction, the better they're going to like it, regardless of what your credit scores are or your down payment is. They're going to look at that, because when you move into a home, there's usually always something that's going to happen through the process. And when you talk about investor loans too, they've actually changed that, where the investor has to have 6 months reserves. And they want now 6 months reserve for every investment property that they have, just not the one that they're buying. So
let's go back and talk about some of the information that a borrower is going to provide. One of the things that I've noticed that the regulation has increased on is the sourcing of funds. That underwriter wants to know exactly where every penny is coming from that you're going to utilize in the transaction, for the purpose of knowing that you're not going out borrowing money for a down payment on a home, unless it's from your own assets.
Exactly. One of the things that they do now is they'll look at your bank statements. They want the last 2 months' bank statements. And if there's deposits in there that can't be verified, like a deposit, direct deposit from your employment, there's deposits in there that are just showing up. An underwriter is going to come back and want to have those sourced, and that means where did they come from? And
provide a paper trail.
Exactly right. Now, if it's 1 or 2 that are like 300 here or 500 here, that may not be a big deal. But if it's consistent, or if it breaches, some companies are at $500, some are at $1,000. But if it breaches that mark, then they're going to want to know where that money came from.
Yeah,
and,
right.
and you know, I have just had a case recently where an elderly couple, they sold their house, they were looking to you know, buy a new house, and got their bank statements and had all these deposits coming up outside of their regular employment checks. And so when I asked them that, they said, well, it's coming from, like, say, my son who's helping me with the utilities, or my daughter who's sending this. So all the children were sending money to the parents just to help them along on a monthly basis. So you had all these deposits. So what I was able to do is say, that's fine. I said, but we're going to eventually have to source these funds. So you haven't found a house yet. You're still looking in the process. So what I want your children to do is, as they write you those checks, just put a memo on the check saying, you know, for utilities for mom and dad or something like that. You make a copy of that and then a copy of the deposit slip, and that matches up with the bank statement. So you put that in the file, and you just put a little note so the underwriter sees that, no problem, slides right through, and your stress level is much lower.
Right, right. I've had a case recently where a couple came to me for a pre-approval, and you know, they provided me their documents, and I'm like, okay, where is the money that you're going to utilize in this transaction? Well, it's at home. What do you mean it's at home? It's under your mattress? Yeah, it's mattress money. I had to advise them, I'm sorry, you cannot use those funds until you season them. Seasoning means they have to be in the bank account without any deposits adding to them for 60 days, correct?
Well, you can add deposits to it, but they want to see that those funds, that's why they get the last 2 months' bank statements. They're going back 60 days to verify.
It's seasoned.
Right, that's what they call seasons, where that money is coming from. You can add deposits to that, but then you have to show where they came from.
Right.
So if you're just putting a chunk in the bank, like $10,000, and you say, oh, I kept it at my house, they're not going to accept that as a source of funds. Right. So that could be causing you an issue. And that's why when you set up with the person originally, you want somebody who's knowledgeable, you want a licensed professional that's going to be able to tell you these things, and then also develop a strategy of how you're going to be able to use it in the future, but what you're going to have to do in order to be able to do that.
As I mentioned earlier, the regulations have increased tremendously.
Tell me about it. It's driving us crazy.
I know. Let's talk about tax returns a little bit and the importance of tax returns where they used to not play a role when a W-2 borrower would apply for a loan. Well, now they play a big role.
Right.
Why don't you explain your experiences with that?
One of the things that we look at now, and the reason we look at it is because underwriters are going to look at it, but they look at all the schedules that you're getting on the tax returns. So when you get, it used to be a W-2 employee would just look at your W-2s and then your year-to-date pay stub. And if that was in line, we would count that. Now what they go back and they look at, for a W-2 employee, they look at your Schedule A. And what that will show is a line on there called unreimbursed employee expenses. So say if you're a truck driver and you write off miles that you drive your car, or if you have the truck you're driving, or parking tolls, or anything like that, then what's going to happen, you subtract that, you write that off as an expense, but that's going to be subtracted from your income. So say if you're making $50,000 and you're writing off, you know, $5,000 in unreimbursed employee expenses, the $45,000 is going to be the number that we can use for qualifying purposes. But if we don't know that up front, we don't find that out until later, then you could have a big issue as far as getting your loan through, you know, if you do it after you write the contract. Right. That's why we try to get those things up front. And then when you talk about schedules, they're also looking at Schedule C, which is the schedule for a self-employed person. You know, it used to be you had these easy programs like stated income or no doc, and people would say, well, I make, you know, $80,000, and that's the top of that's the gross income. But what they're actually looking at is subtracting all the expenses out of that gross income, and they're coming up with a net. There's certain things we can add back in to increase that, but it's going to be a lot of times considerably less than what the gross is, because you're subtracting out advertising, business expenses, employees if you're paying employees, insurance, all those things are coming out, and then you get a bottom line. So it can make a big difference on what income we can use as far as qualifying you is concerned.
And it's extremely important to know what is being claimed on your returns. You could say, hey, I've got this great accountant, he gets me a big refund every year, but what you don't realize is he's decreasing your income to get you a bigger refund. And that decreased income is exactly what the underwriter is going to look at to determine your debt ratio.
Yeah, you bring up a really good point, because so many times we'll get people in and they'll give us copies of their tax returns, and we'll ask them questions about certain lines in there, and they say, I don't know. I just sign the returns and that's it. And what we want to do is we want to make sure, or what the person should be doing is making sure what information is on their tax returns. Now, one thing that the IRS has done is that they're requiring tax preparers to be licensed. And so that's going to eliminate some of those issues or concerns, but still an accountant or anybody can write off that information. So you want to be aware of if that stuff is being written off against your income to lower your taxable income, what is that is effectively doing is reducing the amount of income that we can use for qualifying purposes. Now, there's certain things that won't count against you, like if you're making deductions for a 401k, you know, pre-tax deductions for medical expenses, that sort of thing. But there are other things that will count against you, and those are the things that we want to look at and identify up front so that you don't get caught down the road.
We only have a couple minutes left, but let's talk about what role the credit score plays in the interest rate and the programs that you qualify. We know that Fannie Mae has recently increased their minimum credit score to a 580 to a 620. And there's also this thing called soft pull. Soft pull. Why don't you explain for our viewers exactly what a soft pull is?
Well, basically, what has happened is the credit report has become so important. It used to be that we would just look at some basic information like the date of birth, social security number, and then they look at their history as far as their payment history and the type of loans that they have, you know, the amount of monthly payments.
Right.
Now they're looking at things like inquiries. How many times somebody has checked your credit, other companies and stuff, how many times you've checked or asked people, or you're trying to establish credit in different areas, that affects you. They're actually looking at previous employment and matching that up with what you've given to the lender. They're looking at previous addresses now. This just came up in the last 2 weeks, that you have to explain your previous addresses, where they came from, you know, who they are, if they're yours or they're somebody else's, you know, yes, this is where I live, that sort of thing. So, and all these can impact your credit scores. And what you said, you know, as far as Fannie Mae updating, the higher the credit score, the better the credit risk. Basically, a credit score is a predictor of how you're going to make your payments in the future. So what they're doing is, if your credit score is low, they're just eliminating you from the program altogether. So a lot of programs, if your credit score is low, won't even be available to you.
Jim, thanks for sharing your knowledge with our viewers today.
Well, thanks for having me, Mark. We'll be here again, I'm sure.
We realize we have just thrown a lot of info at you, then you may have questions. If you would like to view this program, please visit our website at markrigney.org. You will see a link to this show on the website. Remember, if you have questions, please email us. Our emails are listed on the screen below, or you can visit our website. We will read some of your questions on our next show. On behalf of my friend and colleague, Jim Perkins, thank you for watching Mortgage Solutions with Mark Rigney. We will see you next time.